financial markets, which could or may reveal a deeper understanding of what drives their predictability. And for this, in order to understand these things, he studied physics, applied mathematics, and computer science at the University of Witwatersrand, and he has a PhD in applied mathematics from UCT. And what is interesting is before returning to academia, he worked in industry in roles such as, fund manager, strategist, and as an algorithmic trader. He can explain all those words to you. Let us give him a welcome.
Thank you very much. Okay, thank you. So I'm Tim. The main thrust of today's talk or discussion, I hope, is to try and convince you that the problem with automation is not working with machines, but working alongside machines. That's going to have to change how we think about computers, automation, robots, and so forth. And for me, what is very exciting about studying financial markets is this realization that financial markets are more like a product. So the best way to think of a financial market is an ecosystem or a collection of different living, competing organisms, hence the picture in the background. My background, getting back to the kind introduction, is that I started in physics. I then migrated into cosmology, so studying the large-scale structure of the universe. And what really excited me, so where did all the structure come from? And after spending a decade doing that, you start to realize that it doesn't tell you very much about one's own condition as a human being. So I then thought to myself, like, what is the most fundamental thing we do as human beings? We trade. We buy and sell stuff from each other. So I then got a quant job at a bank, and I spent over 10, 15 years building trading tech and investment tech for financial services. And I learned two things. The first thing is that in finance, people are not concerned about the impact of the decisions they make to greater society, categorically. It's not a value statement. It's just the nature of how we organize ourselves. So this whole conversation today is to build the argument that it's very, very worthwhile thinking very, very carefully about how we build models, how we simulate, and how we automate things in financial markets. And this is for one reason only. In the physical world, when you build a model, you don't change the world around you. In financial markets, when you build a model, you change the world. The world actually becomes a different place because the models we build, how we define the math, how we choose algorithms, it changes how we interact. It changes how we think about those interactions, and it creates a complete new world. And that's the complexity in finance, and it's also the complexity in economics. Because economics is probably the most difficult social science. It is not like physics. It is not like applied math, where there's this concrete, fixed reality out there that you can go and measure. You can interrogate it. In the finance world and the economic world, the stuff you build becomes real. It becomes its own thing. And that's the danger with automation. And so that's what I study. So I'm going to take you, first I'm going to try and describe to you, and please interrupt and ask questions, how prices are generated in modern financial markets. So I'm going to describe the mechanisms that kind of generate the data. That's going to be high level. So you have insight into how the data is generated, and then I'm going to talk a bit about how the data is used. And that'll lead us into a conversation of how the data is misused, misunderstood. And it is not misused and misunderstood because people don't understand the system. It's because it's extremely efficient and effective to exploit other people for profit. Make no misunderstanding about this. The technology works very well, but not in the way that it's sold to society. All right, so let's start. So if I get my little pointer working, the high-level case is the best way to think of a financial market is as an ecosystem. Why? Because it's full of people. Atoms don't think. So in physics, you have particles and this whole wonderful edifice of theoretical physics, but constituents don't think. They're not purposeful. They're not strategic. All the little atoms that make up society, all of us, we think. We adapt. We are purposeful. We are strategic. Hence, there are very nonlinear feedbacks. And that gives us an ecosystem. So in this picture, you have stuff happening very quickly. You have water flowing down the stream. It's really fast. Next to it, you have trees that are growing on time scales radically different. On those trees, little ants are doing things. In the kind of the physicsy worldview, those little ants on that tree somehow magically generate the whole tree. When in fact, in a real ecosystem, the tree and the ants coexist. There are niches on the tree that the ants try and exploit. So this is a very apt picture. Think of traders as those little ants. To think that those ants can generate a tree is completely misguided. Those ants are there because the tree provided a niche that they could exploit, and they are very effective at exploiting the tree. However, the difference between this kind of nice ecosystem that you see here in financial markets is that those ants can in fact change the tree itself. And that's what we're going to explore. This is the one kind of really nasty technical slide, I guess. Why I'm putting it here is there's two words there. The one word is hierarchical, and the other one is causality. Financial systems like ecosystems are hierarchical, have layers. And what that is telling you is that in a financial system, you cannot think of the whole thing as one big complete, neat, nice little system. There's all these little modular components competing. It's truly hierarchical. When you climb into the box that traders live in, it's a radically different world from when you climb into the box that a fund manager lives in. When you climb into the box where the economists are trying to kind of manage the economy, it's a completely different world. And the assumption that these map neatly into each other is where the opportunities are for machines who trade. They exploit this idea that this is seamless, mechanistic whole. So at the top, you have long-term processes like external shocks, wars, the impact of global economics, all that kind of stuff. It's top-down, it's macro, it's global. Dropping down a bit, you can kind of get into global structures. These are not long-term processes, not like history's position on economic decision-making. It's really the feedbacks and dependencies. It's kind of year-on-year trade, exchange between businesses. Until you get down to the observational level where you can actually measure stuff. This is the only place where we actually measure stuff useful, and that's data that comes out of stock markets. This is indirectly measurable. You can see it through patterns in history. You can see it through patterns in some very aggregate economic indicators, but it's actually indirectly measured. This is the only point in the whole financial system where it's direct measurement. And that's why, for me, financial markets are super exciting. They're like social science colliders. Financial markets are to finance what kind of the Large Hadron Collider is to physics. So that's the observational level. Below that, there are local structures. Things like the rules of trading, the rules of accounting, the tax laws. These are all structures, although imposed top-down, manifestly affect the structure of the system. And then you have short-term kind of processes, so traders doing stuff, liquidity shocks, and so on. But so this is all the little stuff going on, all the little trading and fighting and so on in a market. So low-level processes, high-level processes. There's high-level hierarchy, some world up there of macroeconomics and regulatory effects, and then some world down here of traders and market microstructure. So we're concerned around this level where we can observe stuff, where we can see the raw data being produced by actual trades. So the story is that in that observational level, the way to think about a modern financial market is as a social science collider. We are observing people engaged in trade-driven betterment. So up front, I'm of the view that the view of capitalism and the view of Marxism are both fundamentally flawed, and in fact they're the same thing. You can fold capitalism and Marxism back into themselves, and they end up at the same kind of normative framework. I'm of the view that, and this is, I can't claim it, it's by a historian of economics called J.J. McCloskey, that in fact the enrichment we've seen in the last 150 years, let's say 300 years, is because of trade-driven embetterment. It's because of ideas and innovation. That has given us everything around us. When you look at the world through that lens, you start to see how exciting it is that we can finally measure this, have a completely positivist, data-driven perspective on how we organize ourselves financially. So physics, Large Hadron Collider, you can use your big machine to take photographs of what all the little particles are doing. So it's really a camera. Your models are a camera of how the world really is. At the resolution of the camera, of the machine, this is real. in financial markets, the stock market is a detector, no different from that detector. But the big difference is this detector is an engine. That detector is actually changing the nature of how we interact. By the choices of models, by the choices of regulations we make, we manifestly change the world. So yeah, that's a collider, takes a photograph of the world, that's a collider, and it actually is an engine that drives the world. So if we're going to automate this world, we better be really, really careful of what we're automating it for. So just to give you a sense of the data, right? So many of my colleagues in astrophysics and physics go from there, brag how big their data sets are, right? And how they're going to have petabytes of data and blah, blah, blah. 20 years ago, stock markets were trading more data than was generated by CERN, right? To give you the size of these data sets in finance, remember this is all proprietary, all commercial. So the revolution in kind of automated trading in the US, which is 11 exchanges and over 30 venues, we're talking about exabytes of data generated a year. So just to give you a sense, right? So each market generates about a terabyte of useful science data per day. Terabyte per day. And there are 11 of those in the US, over 300 in the world. So we're talking about a lot of data. And this was 10 years ago, right? So if you put in kind of derivative markets, other markets, cross-currency markets, you're talking about a lot of data. This is commoditized. This is off the shelf now in finance. Now, if you step back into kind of the world of academia, where people are going on about how big SCAR is and how big the LHC is, right? That's because it's publicly funded. And the problem here is that when you look at the financial market system, this is proprietary. This is for profit. This is commoditized. This is off the shelf. So no one's interested in making a big hoo-ha about it. Industry has the initiative, categorically. Your Googles, your Facebooks, your Amazons, they have the initiative in this kind of world. Your Goldman Sachses, your whatever, right? They have the initiative. Universities and publicly funded science have completely and categorically lost the initiative. Internalize that, right? And then realize that as a public, we have no control over the modeling decisions being made that changes the system. And I'll try and explain to you how the system has changed. So, social science collider, stock market, physics collider. It's a camera taking a photograph of the world. This is the engine that drives the world. And it's data that's out there to be studied. Where does this data come from? It comes from a market. So what I have to kind of describe to you now is really a cartoon version of a stock market or a market. The fancy word is tenome, and it comes from the French word to grope for, so you're groping for the price. The idea is you have a market where people throw in bids to buy and offers to sell, and through interchange, somehow the collection of people grope towards the right price that gives you a fair value, and then you know the value of the asset. And that brings in the whole debate is, does the price you see in a market reflect the actual value of the asset? It most certainly does not. So one must not confuse price with value. But the idea is that somehow, through trading interaction, you can value an asset. That is now known categorically to be flawed. So valuing is a completely different argument, and all arguments around the value of labor, the value of assets, are now immaterial to this world of automation, because trading determines the monetary value. It's really trade-driven betterment. You throw away all the baggage of the normative theories of how we're making the world a better place, and you just basically exploit the networks of trade we have right here, right now. We don't care about anything else, and it's quite concerning. Anyway, so this is the market. It's called a limit order book. Why is it called a book? It's called a book because it's something with a collection of things inside. So it's a collection of stuff. What is it collecting? It's collecting these limit orders. So in financial markets, there are two kinds of orders, a limit order and a market order. A limit order has a price and a volume. So I want 100 shares at a certain price. So it's limited, it's a limit order. A market order, on the other hand, is an extremely aggressive order. I just want to buy the 100 shares now. I don't care about the price. So two order types, limit order, market order. Market order, I do not care of the price. I just want the order. I just want the inventory. I just want that share. That is the share I want. Wake up in the morning and suddenly I really, really want Bitcoin. I just go and buy lots of Bitcoin, irrespective of the price. And then, of course, the price shoots up, right? So market orders can generate very big price moves. Limit orders is I think I know what the value of that company over there is, so I will only buy that share at that price. So this is a book that collects all the limit orders. There are two kinds of limit orders. The ask side will offer, and these are sellers. These are people that want to sell shares that they have. These are the buyers. They want to buy shares they have. You'll notice that the price they buy, or they buying from the market, will be lower than they sell. How is this possible? How can you buy high and sell low? That's because they are the market makers. They are offering to buy from you, the market, and they are offering to sell to you in the market. So these guys are basically standing up in the middle of the floor and saying, does anybody want to buy from me? And these guys over here are standing up on the floor and saying, does anybody actually want to sell to me? So offers or asks to sell, bids to buy. Halfway between this best price of all these sellers and this best price of all the buyers is something called the mid price. And that's something one can measure and model, and a lot of science is done with that. So how do market makers make money? Why should somebody put limit orders into this market? Well, if I can buy from you at this low price and then say sell back to somebody else at a high price, I can earn that spread. And that's what I take home to pay for my, I don't know, luxury car and swimming pool or whatever, right? So the idea is in markets, for them to be efficient, you want the spread to be really narrow. Well, the market makers, they want rules and regulations and stuff for this to be as wide as possible, because that's where their profit comes from. Okay, so that's the limit order book. Is everyone happy with that? We have this idea of limit orders, market orders. So let's go through a few trades. So I'm going to go through 5 events. We have our mid price. A new limit order is going to buy. So it's a limit order, so it has a price and a volume. Therefore, it's going to go and rest inside the best bid side, or the bid side. So there comes our little limit order. And it travels along, and then it pushes the old one back, and it rests in our limit order book. For that reason, it's called a resting order. It's passive, it's a resting order. You'll also notice that the order that was there has preference to this order. So the order that they are in the order book is important. So when a new trade comes along, it'll hit that guy first. Time priority. All right? So the next thing that happened is an aggressive market sell order arrives. This guy really, really wants to sell right now. For whatever reason, he doesn't care about the price, he just wants to sell. So he's very aggressive market order, comes in and it smashes the order book, and it's literally called smashing the order book. And when it hits the order book, it'll pull off all those resting orders. It'll generate a price. So if you go back to that trade, you'll see that that part of the market order had 2 separate executions, and then that little piece had to go and execute against the next layer in the order book. So it drilled down into the order book. The spread increased, and the mid price shifted down, and you get these 3 orders printed. You have a price at 33 cents, at a time and a volume. So timestamp, volume, 75 shares at 33 cents. The next one was exactly the same time, another 75 shares at 33 cents, but when they had a drill down into the order book, the next execution was at a lower price, 24 cents. So you can kind of see the mechanism. This is a separate issue, is that in markets we only see the lit order book. What we really want to understand is what's called the latent order book, and that's the mutual funds. Who really drives real markets? It's the big guys, the mutual funds, the government treasuries, and so on, right? So there's this like latent liquidity lurking out there that kind of dabbles into the lit market when they want to. We can't observe that directly. We can only observe this part of the order book. Now that you have a sense of how markets operate, that little mechanistic part, why machines? Why bother with machines? What advantage do machines give us? and it's got to do with our response time. So a really good human trader can see the price on the screen, make the decision, and hit the button in about 220, 230 kind of milliseconds, right? So about a quarter of a second. So the human response boundary is considered to be about 200 milliseconds. So the response time of a good trader and a fighter pilot are about the same. It's a very, very similar mentality that you've got to make very, very quick decisions based on marginal information automatically. The advantage that machines have is they can push through the boundary. And this started happening in the late 80s into the early 90s with the first PCs, and really took off between 2006 and 2007. In the US, in 2007, new regulations came in called Reg NMS and Reg ATS, which formally forced every exchange in the US to trade through the same network. Once that happened, you had to be automatic. Once it became automatic, you could push through the human response boundary, and then you could basically beat the human traders. So the first game then was, we're going to augment the traders with trading tech. So we're going to give them screens, and those screens are going to have buttons, and those buttons are actually going to trigger groups of events called algorithms, which they used to tap out by hand. So rather than actually, I'm going to buy, I'm going to sell, you pick a collection of algorithms that are going to operate the buying and selling for you on certain timescales. But that selection of algorithms is a very, very difficult problem that has only recently been solved. So it still left many traders, and those traders became known as algo traders or quant traders and so forth. And the big game at the banks was you'd bring in a whole bunch of quants and they sit in the corner, and then you've got all these human traders. They would watch and measure the human traders, reverse engineer all their strategies, automate what they can, and they'd fire all the traders. And then you're left with 6 or 7 traders left over from the 600 or 700 that used to be there. So you saw hiring and firing on kind of on Wall Street specifically, where whole floors of traders are replaced by a small research team of applied mathematicians, computer scientists, and physicists. So you'll see this massive laying off of people trained in accounting, traditional trading, financial analysts and stuff, all laid off because they couldn't program effectively, and they didn't know the math stats and the applied maths. The guys coming from the science side didn't have to know any finance. All they had to do was mimic the traders through their data sets, which is what happened. So there was a massive hiring wave of statisticians, applied mathematicians, and so forth into Wall Street, and a massive firing wave against everyone coming from a commerce or business science training. Why were people so committed? Because this had been tested before by 2 big hedge funds, the famous one, Renaissance Technologies. So Renaissance Tech is the world's most successful hedge fund. They don't hire anyone, never have, for 40 years with a Wall Street or economics or finance training. You have to have a science training. You have to have published in the top science journals. And your interview is based on your science, and then they hire you. So Jim Simmons' fund is kind of, the Medallion Fund is still the most successful hedge fund in history. The 2 other quant funds did exactly the same thing. They basically only hire people with a STEM training. It has taken 30 years for the technology to mature to the point that they are now utterly decimating anyone who's not doing it. So there's something called a FEMA-Giddon going on in the asset management industry, where fees are being pushed down so aggressively that the fund managers can't pay themselves bonuses anymore. And that's basically a kickback of this automation. So just to get an understanding of what happened is that in about 2003 to 2007, a lot of quant funds, automated asset management funds were born, but the industry very aggressively shut them down. So a lot of those businesses shifted from, oh, we are quantitative asset managers. No, we're passive, we track indices. So they took the same tech, and then they said, oh no, we're going to track indices. We're no longer competing with you. And then over a decade or so, companies like the PIMCOs of the world, the BlackRocks, slowly then pulled market share away from the human-operated traditional funds under the guise of passive. So there's this whole passive active thing was completely manufactured by the passive guys in order to kind of get market share, pretending that they were not taking kind of aggressive, automated, machine learning-based bets. So now we sit in the world where passive is cleaning up, but it's anything but passive. It's actually just quant trading repackaged to get around, maneuver around the politics of funding. So this is what's happened, and it's all about this human response boundary. The technology is pretty sophisticated. These are very big teams. I think the challenge to many traditional asset managers and trading shops is that the idea is you've got all this whole room full of fund managers who like to have meetings and traders who like to have meetings. And their idea is, oh no, we just need this one PhD applied mathematician and computer scientist in the corner, write us some computer stuff. With the computer stuff, we, the rest of the room, taking our bonuses, can just use those computer stuff and compete against these guys. This is not how these guys operate. You're talking about teams of 20 to 30 PhDs designing the tech, handing it over to teams of hundreds of software engineers to test it. I mean, Rentec has over 1,000 scientists building their technology. They don't have any fund managers. They don't have any traders. They don't have any economists. So the mindset is just radically different. You've got scientists and engineers just dropping all the legacy stuff because this technology stack is so difficult. The data is at the heart of it. You're getting your 50 terabytes of data per day. There's a whole bunch of other stuff, but there's really two components here. You have your market data, and then you have this thing called this algo chassis. And there are two components to that. There's the machine intelligence part. So the machine intelligence part is kind of making the decisions, and then there's the machine learning part, which is learning how to improve those decisions. This is all commoditized now. It's off the shelf. And you have a floundering asset management and banking industry globally trying to figure out how to adjust themselves to it. But the business model is radically different. You're talking about guys who are used to building rockets rather than guys who are interested in sitting around a table doing business deals. This is very dangerous. Just some ideas of what the data looks like. Don't worry about the details, but what I want to get across in this slide is how complex and interesting the data is. You see, so the reds and blues are the bids and offers. So there's best bid, best offer. Bids to buy, offers to sell, so it's just the colors are the opposite way around that I had on the other slide. All the yellows are actual trade events. So that's when a buyer and a seller met. So there's lots of little trades in the morning, and you can see there's not much trading going on. And then suddenly there's an explosion of trading. And you're like, why is that? Well, this happens to be Anglo-American, and it happened to be around 10 o'clock that the trading started. And why is that? Just because Anglo-American is dual listed on the London Stock Exchange, and there's an hour difference between when their market opened and ours. So we didn't trade much until the London market opened. Suddenly you can see that how markets interact is extremely complex. So that is the artifact of dual listing and different times across the globe. This is another share. This is, what is this? GRT. Offhand, I can't remember now. But once again, this is very illiquid. So even when the London market opened, nothing much happened. That's because it's not dual listed. Just give you a sense of complexity, the richness of the data. It's the kind of data we have to deal with. Operating on that data, there's always this question of what is high-frequency trading? And there's endless debate about what it is and what it isn't, right? So we go to the regulator, the US regulator. This is how the US regulator defines high-frequency trading. It's very simple. And this is why we have to be very cautious. I'd say most banks in South Africa do not engage in high-frequency trading. They engage in a very watered-down version of quant trading. One or two of them may be algo trading. But they very much like to pretend that they are algo trading and doing high-frequency trading because they feel very much left out, but they're not willing to throw the amount of money that the Goldman Sachses and the Merrill Lynches of the world throw at the problem. Because the boards of the banks here don't have engineers on the boards, they don't have scientists, they don't have physicists, applied maths, and statisticians. They are mostly accountants, with all due respect to my colleagues. And for them, it's a foreign landscape. They're not trained to get their head around running a tech company. But they very, very much want to participate in the tech hype. But they don't actually understand. They've never built a piece of software. They've never run an algorithm. They've never tested an algorithm. But they very, very much like to put a suit on and pretend that they do know how to do this. And that's why South Africa is the Wild West for foreign banks, because it's easy to exploit this kind of unskilled and unaware of it kind of scenario. Anyway, so this is how the SEC defines high-frequency trading. Does the algo decide to transact with the human interaction? Yes, no. Did the human being push the button? If the human being pushed the button, it's not HFT. Did a human being decide what kind of transaction to initiate? Yes, no. If the human being did it, it's not HFT. Does the algo route the transaction between the brokers, between the platforms? Yes, no. If a human being decided where the trade's going to go, oh, I'm at Old Mutual and I'm going to trade with X, Y, and Z, right, or whatever. If a human being makes that decision, it's not HFT. Did the algo execute the strategy? If a human being decided to execute, it's not HFT. This, you can argue, is still quant trading or algorithmic trading. So I think 95% of all equity trades in the world today are algorithmic or quant. I think it's 25%, if that, in South Africa. Right, so it's very interesting. So, well, what is more important, right, is that the low latency side. You can have the algo deciding all of these things. So the algo does the trades, initiates the trades, routes the trade, all this stuff. But was the hardware low latency? Are you paying for the fastest fiber optic cables? Are you kind of paying hundreds of millions of dollars to get computer scientists and electric engineers to get your router boxes fine-tuned? Yes, no. I mean, are you kind of getting the stuff that extra nanosecond off your transmission rates? Yes, no. Most people don't. But when you're in this game, you have to. Are all your connections high speed? Do you try and exploit the order book? And this is the big one. HFT traders try and game all the other algorithms all the time. So the oldest game is where I send as many orders as I can to all my competitors, hundreds of thousands of orders, with a simple idea is that they have to process every single one of those orders and figure out, do those orders have intentions to trade, yes or no? Do they have information, yes or no? And then they are so bogged down in the millions of orders that I'm spamming into the market that the whole market slows down. And as the market slows down, I can then exploit them. All right? And it was the biggest game forever until the SEC had to step in and try and moderate it. It's not illegal, but they had to kind of put kind of speed limits on how much you can spam. All right? And it is crazy stuff. All right? And the problem is the human traders back in kind of the Indias of the world and South Africas of the world, this is just so foreign to them. And the stuff happens in the JSE all the time. Okay, so why is this an interesting thing from a next layer up, the macroeconomic perspective? Well, this is what correlations between assets. So let's have a look at this figure. It's a heat map. The blues are cold, so negatively correlated, and the reds are hot, so positively correlated. These things are all moving together. When this one goes down, the other one goes up, so they're moving against each other. You can't read it, but this is US dollar, NASDAQ, Dow Jones, S&P 500. So this is kind of US market stuff. These are all bonds. And what you see over here from about 2005, June to October 2005, is there's lots of interesting correlations, right? There's lots of interesting stuff going on. You know, a traditional asset manager could go in there and read a company filing and figure out, oh no, there's some heating oil company that's undervalued, so I'm going to buy it and hold it for the next 5 years, right? What the automated trading has done, this is April 2012. I mean, this is a long time ago. This is almost a decade ago, right? Everything is now correlated, so they're basically two trades. I'm scared, I'm not scared. And it's called RORO, risk on, risk off. And there's endless debates about whether RORO stopped or didn't stop. Is it going to start again? Blah, 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 blah. But the reality is that you're either scared, and then you buy Japanese bonds, German bonds, you sell anything as commodity, you sell anything as resource, you sell all the basket currencies, so the rand is a big part of that because it's a very liquid emerging market currency, and you sell S&P 500, you buy everything safe, and you sell everything scary. And then the next day you wake up, well actually 5 minutes later, the thing switches, and then everything changes again. And then you're basically buying all of these and selling all of those across the globe, minute by minute, right? And then in here, back in this world, the fund manager saying, I'm holding whatever this company for the next 5 years because it's good value and it's going to pay me a nice dividend and so on, right? So how do you reconcile these worlds? But the old world is good because you're defending businesses. This is a very dangerous world. This is a world that has a life of its own. Yet we've allowed this to happen. That's kind of the background. Are there any questions thus far? Does anyone interject comments, questions, criticisms? All right. Okay.
I'd like to understand that last right-hand graph better.
This one.
Yeah, with the growing blue.
Yeah.
Do you want to just talk about the impact of these uncorrelated?
The problem is that there are very few uncorrelated assets left. If an asset is now listed on an exchange in part of an index, it's going to be driven by all this kind of dynamics. So the world is separated into private equity, completely off market. Everything on market is basically risk on, risk off. So all of these things are positively correlated. So Dow Jones, NASDAQ, S&P 500, those are all positively correlated with all the other equity markets. So Canadian dollar, Aussie dollar, NASDAQ, S&P 500, all these are kind of the risk on stuff. All of this is the risk off stuff. So that's US 10-year government bonds, Canadian 10-year bonds, German bonds, Japanese bonds. Because the thing is, with this technology, you, the algo, the box, can trade the entire market second by second based on short-term information flow. So basically, the trading is driving the asset prices. It's not, there's no opportunities left to actually find traditional senses of value. Does that help?
Yeah, thank you.
Yeah. Okay, so, yes? Less and less.
Zero.
Basically, yes. So why list a company then and take direction? It's decoupling.
Yeah, it's a trading world of its own.
And that's a very unfortunate situation.
Okay.
Yes.
So you're saying like the value of the company has been taken out of the hands of the company?
Absolutely. At least in a lit market, at least in an open market. So the question is, I mean, this is personal view. I don't say, if I was a business, I would go to the bank and just borrow the money through some structured financing deal, right? I would not go and list anymore. The only problem you've got to ask on the other side is if I'm a pension fund, what do I invest in to secure the well-being of my kind of clients, the pensioners, right? Because you have to list, actually, you should not be buying listed products, but the regulations are living in that world. The regulations are not living in this world. So you hit on both sides, structurally. So but the regulator doesn't see this because they're economists and accountants. And the guys trading don't care. They're just going to build the next rocket. Yeah. Yes. Yes.
And I can appreciate that in the short term.
Yes.
In the long term, doesn't the intrinsic value still pay off?
The problem is that there's no evidence of that. That's the narrative that many asset managers are still punting. And it's turning out not to be the case. Maybe I'm wrong. Maybe evidence will occur. But the problem is that the ebb and tide of capital, remember the derivative markets and FX markets are orders of magnitude bigger than the equity market. And the real trading is in FX and the derivative market. It's like a 1 trillion market to a 13 trillion dollar market. Do you really think that you can kind of really realize that intrinsic value fairly in a market that's dominated by FX and derivatives? I would be cautious. So you got to do, I mean, once again, I can't speak, I mean, this is a personal view, I can't speak as UCT or whatever, but you probably want to delist, you probably want to go private, you probably want to have related parties actively participate in your business. But that's not the narrative one's allowed to have.
Can we just challenge you a little bit
Yes.
more on that? Because you're talking about data and you're saying it's not what the data shows, but it's only been since 2008.
2008, let's say, 2008, 2009.
So are 12 years of data and
No, there aren't enough.
Yeah.
No, they're not enough. And that's where it becomes fuzzy, and that's the bad science part of it.
Yeah.
So with this whole thing of evidence, right, in financial markets, the key thing I want to talk about now is where the bad science comes in. And that this is what you see. It's very easy to draw inferences, right, and to make value judgments. The first thing to worry about is, can we actually model the agents, what the traders are doing? Okay, so let's play that game. We're going to model the traders, right? So we build an agent-based model with some idea of how traders actually trade with little algorithms. And we put it on a computer, and we trade it, and we generate some price time series. So we've been doing this. Lots of people are doing this. So this is an actual price time series, and this is one that our little trading model gives us. It kind of looks right. The problem is, it's a finite piece of data. You know, you can never have enough data. So what we can try and do is make the kind of stylized facts, the characteristics of the data, in a tiny little piece of data look right. So we can do that, right? So the top part is actual. You see prices changing, then big bursts, and prices changing, and big bursts. In our first kind of models, they don't look really interesting. You get kind of the randomness, but you don't get these bursts, right? So where do those bursts come from? Well, they come from adaptation. So this is a second class of models, and we can start to kind of mimic these bursts of trading. And these bursts come from the feedbacks, the purposeful nature of agents. Just to give you, this is another technical slide, but just to give you a sense of it, we take that first model, the one without those bursts, and then you take the price, and you lag it 1 day, then 2 days, and 3 days, and you plot the autocorrelation. So how correlated is the price change today with 1 day time, 2 days, 3 days, 4 days, right? And in real financial markets, the autocorrelations die out. There's no correlation information preserved in time. So our models, perfectly correlated, and all the correlations die out. Great. So autocorrelations die out. The other weird thing about financial market data is you take the absolute value of the price changes. Those are highly correlated through time. And the reason they're highly correlated is financial markets are driven by these large orders that the pension funds put in. So there's order flow, autocorrelation. So in the real world, you know that autocorrelation dies, but never actually dies out on the absolute values. So you take all the returns, plus return, minus return, plus return, minus return, and you throw the signs away. So it's just the autocorrelation and the sizes of the price changes. In real markets, those are highly correlated. You have to get that right. Our models can't get that right. So we can't get this thing called the leverage effect right. And then the third thing is fat tails. So these are QQ plots, right? So the little blue line is if it's Gaussian, normal distribution. There aren't big rare events. There aren't cataclysms and stuff. In real markets, there are lots of big rare events, big price jumps. Our model, first model, doesn't have anything interesting. So the standard thing, the big thing we have all learned globally about financial markets from agent-based modeling is that to get big events and to get the leverage effect, we need adaptation. That means there's no fixed rule in the market. Everything is driven by purposeful adaptation to each other. We are feeding back on each other's activity. So we can build a simple model that does that. This is a very simple model with feedbacks. It's really simple. But you get all the features you see. You get these nice fat tails, so we can generate rare events. We have no autocorrelations in the prices. And we get a leverage effect. What have we learned from this? That it's all about adaptation. But why should agents adapt? What's making them adapt? It's the changing rules. It's the top-down stuff. It's the regulations. It's the capital flows. So first thing we know is we have to model adaptation. We don't know how to properly model adaptation. So that's a big science question. And the reason why is because when I generate this kind of time series, if I go back to this time series, I don't know how probable that one little path is. And in fact, in finance, it's unknowable. You cannot know the probabilities of a price path. Why? Because you only have one measurement of history. You have to make very, very strong model assumptions to generate lots of realizations. To simulate, you have to make a model assumption. But you've only measured one path. It's the same problem that you have in cosmology. We've been measuring data from one realization of one universe. You can't say an awful lot. So bad science number one really is this whole problem of how do you model adaptation when you don't know the probabilities. So let's have a look at that. And it's a little game. Before I put the game up, it's an email scam. So I wake up in the morning, and I need to make a fast buck. How should I do it? Well, I decide I have a computer, and I'm going to email 1 million people. 500,000 people I'll email that my favorite stock's going up, and the other 500,000 I'm going to email that my favorite stock's going down. Right? Suddenly, I wake up tomorrow morning, and the stock went down. All right, so half of my sample think I'm a complete idiot. The other half think, wow, he actually got that bet right. So that group that I emailed that 500 stock's going to go down to, I email half of them it's going to go up, and half of them again that it's going to go down. And I keep doing this for the week until I've got this like small group of people, 10 people left, who think that I can perfectly predict the stock. And then I personally phone them and say, like, I've got this brilliant offer for you, and like for 50 Rand only, I can tell you what the stock's going to do tomorrow. Right? It's a standard scam, and it's remarkable how many people fall for this, right? So here's the scam, and it's a very important thing with machine learning, right? So this half get told to buy, that half to sell. It actually turns out to be a buy. Oops, it's kind of shifted there, so that should be on that part. I then email this half, and it's a sell, and off they go. I sell them. I tell them the next day there's going to be buys and sells, and I keep doing this until I've got a sequence in their email box that looks like I've perfectly predicted reality. I've given this model, revealed this model with perfect insight, and they think I can predict the future. What is wrong with this whole framework? The person who got that email doesn't see all the hypotheses thrown away. That's the big problem in machine learning. It's not whether your algorithm can actually match the data, it's whether you actually know what you've thrown away to get it to match the data. And that is the fundamental problem in machine learning. And that's not a solved problem in finance. Why? Because in finance, the world is changing every day because of adaptation. If I'm going to machine learn pictures of cats, when I wake up tomorrow, the cat isn't an apple, all right? In financial markets, they are, potentially. So we only have one measured realization of reality, and as the email scam example demonstrates, it's very easy to convince yourself that you have the perfect model if you just conveniently ignore all the other attempts to get it to fit the data. The other problem, so this is the one side, so probabilities in finance are probably unknowable because of an adaptation. So I can ask the room, right, so what do you think the probability is of throwing 10 heads in a row? If I gave you each this perfectly fair coin, it's a fair coin, right? So we're not going to worry about the little coin balancing on its edge. It's either going to be heads or tails, right? And it's 50-50 either way. What do you think the probability is of at least one person in the room getting 10 heads in a row? And this is an interesting thing, right? The reason why we all assume that is you're asking yourself, what is the probability that I throw 10 heads in a row? So it's a very small number. So what is probably at least one person in the room? Let's say 1,000 people, right? So I'm very ambitious. So we have 1,000 people. But this is because it rounds up nicely, right? So but you can cut the zero off. So a room of 1,000 people throwing 10 heads of the fair coin. Well, the probability of throwing 10 heads is just at half to the power of 10. So it's like 0.1%, right? This is the small number. But that doesn't tell you the probability of at least one person. So let's have a look at the probability of not throwing 10 heads. So you've got to do the complement of that, 1 minus that number, right? There's a 99.999% chance that you didn't throw those 10 heads in a row. So the probability of not throwing 10 heads 1,000 times, you sit there and you throw that thing 1,000 times, is 37.6%. So what is the probability of not throwing 10 heads 1,000 times? Because that is the probability of at least one person in the room throwing these 10 heads. It's actually 62% for 1,000 people. So it's a very, very high probability when you have a large enough people that one of them got really lucky and threw those 10 heads. Even though from the individual point of view, it's extremely unlikely that you threw that sequence of 10 heads. What do you think happens when you suddenly threw those 10 heads in a row? Wow, I'm the best coin tosser in the world. I'm just so good at throwing coins. Thank you very much. You know what I mean? So there's two problems. One, in finance, because of adaptation, it is very, very difficult to account for all these other hypotheses. And also, it's very, very easy to convince ourselves we have skill, that we are really skilled at tossing these coins, because there's so many people trying. So one has to think very, very carefully about how one builds models and tests models in finance. And asset managers make this mistake all the time. In fact, most asset managers, in my opinion, personal view, is that this is how you sell it to clients. An asset manager never gives you the probabilities. What they give you is a time series plot of how their fund is better than the other funds. It's really bad science. But it plays to all our behavioral biases. It is the easiest way to sell. So I would submit that it's unethical to present a time series plot to somebody not trained in statistics, in computer science. It's fundamentally unethical. Yet somehow regulators just don't care. All right, so these are two fundamental problems. This is the bad science to a backtest. The other one's a bit more of a technical problem for people who have a bit more technical inclination, is these correlations, right? We very conveniently and easily talk about correlations. But it really, really matters how we calculate them. If the world is continuous, there's a rich theory that tells you how to calculate these things. If the world is discrete, with little events, little trading events, it's very difficult. So this plot is just saying that calculating correlations really matter. Bad science. On this method, it's 6% correlated. On that method, it's, 2% correlation. Most people would not be able to see the difference. A machine does. Machines exploit this all the time. One of the fundamental tricks in high-frequency trading is how you calculate correlations. You do it in machine time on events because you know the human trader can't do it. And you know the fund managers are definitely not doing it. So the fund managers are living in this kind of world, and the traders are living in this world. Very easy for a machine to exploit. The next thing is, okay, let's say I give you the world's perfect model. So perfect, I mean, it's deterministic. So on this graph over here, I've got 1, 2, 3, 4 curves. These are just polynomial curves. Let's say that the real world is the black line. God gave it to us. It's perfect. We know it, right? But the problem is nature only gives us 1, 2, 3, 4, 5 data points. The big question then is, with those 5 data points, can I get anywhere near any of those things? No, you can't. Yet we keep convincing ourselves we can. Oh no, it's a straight line. That seems quite convincing. No, it's a parabola. All right? Then you wonder why there's a replication crisis in science. Well, like 85% of research is not replicated, right? Because the thing is that even if the world was deterministic, we don't have enough data to say anything meaningfully. In fact, you can prove that those 5 data points are no different from either being a random, purely random set of points, or being a purely deterministic sample of a real deterministic function. You cannot differentiate between the randomness of those 5 points and them being deterministic. Okay. So that's also a big problem. The other one, I'm going to skip over this really fast because we're running out of time, but Occam's razor is you should always pick the simplest model that suits your data. So the reason why, if we go back to that, we probably end up with a parabola, is that by Occam's razor, we should just use a parabola. We know it's the wrong model, but it's the simplest model that fits the data. But Occam's razor permeates all of our scientific methodology. The question is, in finance, is it actually telling us anything about the real world? Unlikely. In the real kind of physical world of physics, yes, because the world's not changing. So Occam's razor is quite dangerous, but we have to use it for machine learning purposes. Okay, so I'm going to skip this one really fast because I want to get to the capitalism marketing discussion. The high takeaway from here is this is really bad science. Essentially, the argument is there are new ways of communicating, globalization, new sources of storing energy, and there are new ways of moving goods, services around, right? But this has been going on for 3,000 years, if not 5,000 years. It is a seamless, organic sequence of mishmashed history.